Hey folks, welcome back. Kicks Over Coffee, Andy Polk. I've got my coffee cup, and I know it's my coffee cup because it says coffee. There you go. I'm joined today with our chief economist, Gary Rains, FDRA's chief economist. And I wanted to have Gary on for a Kicks Over Coffee, not so much to talk about footwear product, but kind of what Gary and I dubbed SHOECONOMY, right? So it's the economics of the footwear industry, where we're at selling shoes, economic indicators, consumer confidence, disposable income, all those different factors that tell us whether we're going to be up or down in terms of selling shoes to consumers this year. So Gary, welcome. Thanks for all the work that you're doing to track this stuff. I'm a little freaked out right now based on news that's coming out. And I think what today we're trying to do is unpackage it and say, is this obviously media, in this day and age, go a little bit overboard in terms of storylines because they've got to grab viewers' attention. But it seems like there's this divergence of, if we look at Wall Street, we see earnings doing okay. Like companies are typically doing okay in this environment. We see unemployment super low. We see wages are increasing a little bit here and there. We don't see inflation, but then we've got things like the trade war that are causing people great concern. We just saw the bond yield invert for the first time since the last kind of recession. So I'm having you on today to kind of help us as an economist unpackage some of this stuff. As what's happening in the greater economy and tie it back down to shoe stores and consumers purchasing shoes. So,
sure.
Welcome to Kicks Over Coffee. Do you have a coffee cup with you?
I do.
What do you got in there? Folgers?
Only the best. Today we're sporting a homebrew.
All right. So, first of all, I know you want to start off talking about shoe stores with people out there where we are currently. This is stuff we provide to our members every single month, but if you want to go ahead and pull up your screen so people can see that, and then you and I'll just converse about the numbers.
Fantastic. All right. Well, as you said, Andy, the first slide to begin with here is a look at shoe store sales, year-to-date sales, and how that corresponds with full-year sales. Unsurprisingly, since we have data through July so far, it's a pretty good indicator of how full-year sales are likely to trend. We see that year-to-date sales sitting right about here strongly suggest that full-year sales are going to end comparably, maybe somewhere north of $38 billion at U.S. shoe stores. Not only is that set to be a record year, but it's a pretty impressive growth.
Yeah.
In fact, if we look at this chart not in dollar terms, but in growth terms, in year-over-year change terms, it would look something like this. And we see this, pretty impressive growth, 6.5%, maybe 7% year-over-year growth, at least based upon the first half of 2019 compared to the first half of 2018. It strongly suggests we're likely to see impressive growth for the full year, but I'm a little hesitant about that just yet, and I'll explain that more in a moment.
Okay. So good numbers to look at the start. That's encouraging.
Absolutely. It's been a really impressive, strong first half of the year with double-digit growth seen there several of the first couple of months of the year. In fact, much like you had said a few moments ago, consumers are spending willingly at shoe stores in part because there's plenty of money available. Everyone is working. Unemployment rate, as you said, is very low, and household net worth is very high. In fact, the latest data from Uncle Sam shows second quarter 2019 household net worth was at a record level this year. With net worth so high, of course, that's driven in part because the unemployment rate is so low. As I said, everyone's working. We're seeing the unemployment rate, hover just below 4%. It's the lowest since 1969. It sounds like everything's coming up roses, and I would caution that that's oftentimes when you begin to see it might be a good time to think about heading for the exits when the dance music is playing. A big indicator there is looking at this unemployment rate. Again, it looks great. The unemployment rate, below 4%, the lowest in half a century. But if you notice, these little gray bars in here, these little gray bands are shaded areas, and they indicate recessions. And if you notice that every single time the unemployment rate gets pretty low, 4.5%, it tends to foreshadow a recession in the U.S. The accuracy is very strong. The timeliness behind that when a recession is going to happen is not as strong. It can vary from from a short period to a long period. But don't take the labor market's word for it. There are other indicators that point to the same thing. Just as you had said a moment ago, pardon me, when you said a moment ago, when we look at the yield spread.
Yeah.
Here I'm showing the 10-year yield plotted against the 3-month treasury bills. Now, typically, a longer dated maturity tends to have higher interest rates than does shorter dated maturities.
So grandma buys me a 10-year bond, and it's supposed to pay out more in interest because I'm giving them the money over the long term versus grandma buying me a 3-month bond that's short term, and there's not much value for the bond itself to pay back, right? So
Sure. Yeah, the opportunity cost is a part of the issue, but yeah, absolutely. Typically, the longer, the further out the maturity is on that instrument, that treasury instrument, typically the higher the interest rate tends to be, typically. And we see that over the long term, gosh, dating back maybe 35, 40 years ago, 35 or 40 years worth of history, that's almost always the case, that the 10-year commands a premium over this 3-month treasury.
Right.
But you see here that we've seen how that has gone negative. Essentially, the 3-month, the interest rate on a 3-month treasury bill is worth more than the interest rate on a 10-year bond. And you think, well, how can that be? That seems just counterintuitive. Well, really, it is counterintuitive, and it has some more complicated economic issues behind it. But a big one is essentially a bit of an oversimplification, perhaps, but people just aren't as long on the U.S. economy as they were in the past, and in turn, we see that people are not as willing to invest their money for longer terms in the U.S. economy, via the 10-year bond that they are with shorter instruments.
Isn't there some kind of phrase in economics that says like $1 today is worth more today than it is later, right?
Absolutely.
So in this, what we're typically saying, this is kind of a gauge of confidence over is the longer term confidence gauge of saying people think that the economy is going to slide in recession. We have too much debt to pay off federally with the U.S. government that may cause inflation or cause any number of things. So it's just the long-term play is just way too nervous. So I guess people in this instance, what this is telling us is people are starting to put money to the side instead of putting into bonds or investing in the long term.
Yeah, particularly on the longer-term instruments. Absolutely. We see this inversion is the case not only here looking at a 10-year versus a 3-month bill, but just today, the 10-year plotted against a 2-year treasuries. It also just barely went negative today. And you see again with these recessionary periods that it also tends to foreshadow a recession in the U.S. over the last, 35, 40 years or so.
What's the difference between the one you just showed, the bonds and treasuries? What's the difference?
Well, they're all treasury instruments, treasury securities. Notes are longer term contracts. Bills are shorter term contracts. And it's not. We see how things had gotten choppy back here in the late '80s, and that had to do with the double-digit interest rates and double-digit inflation we saw at the time, and the Paul Volcker era in the Fed. And I'll talk about that in a few more moments. But just the big point to keep in mind here is that if it's not interest rates that are predicting a recession sooner or later, it's not unemployment predicting the low unemployment rate predicting a recession sooner or later. You can look at industrial production. This is really boots on the ground, and it also is foreshadowing what is likely to be a substantial slowdown in economic activity in the U.S. In the latest month, we see that the year-over-year change in industrial production in the U.S. was only up about 0.5%. That's the slowest in about the last 2.5 years. While not negative, at least not yet, we do see that when industrial production slows and eventually goes into recession or goes into contraction, we see that again these gray shaded areas tend to coincide, just about overlap perfectly, or with just the slightest bit of a lag between the two. So someone would say, oh, well, the interest rates and the unemployment rate, perhaps that's a bit more esoteric and pie in the sky, and that's Federal Reserve stuff. Industrial production, that is, as I said, that is boots on the ground. That is, yeah, exactly. That's the hard product doing the production now. So one could just about say that despite Trump's best efforts, that manufacturing in the U.S. is, while not in a tailspin, it's pretty close to an outright recession already.
Well, it's hard to make product you can't export to one of the world's second largest economy and shutting it off to us. So
absolutely, absolutely, really is.
That the trouble is when you look at that and you look at industrial production here in the U.S. If it continues, then it has the potential to have a precipitous drop. Right? It's not going to edge down. It's just going to flatline at that point.
Sure. Going beyond the industrial production example, looking at a Federal Reserve model that they use to predict the likelihood of a recession 12 months ahead. And again, going back, 1961 or so, last 50 odd years, you can see how this black line, this predictor of recession probability using Treasury spreads, sure enough coincides with these blue or gray shaded areas just about every single time that it tends to get over a certain threshold. Well, someone would look now and say, well, yeah, okay, it's inching higher, but it's only 32.8%. Yeah, perhaps I'm willing to play those odds. Well, maybe. But again, I mentioned earlier the Volcker era when things were a little loopy because of double-digit interest rates to combat the escalating inflation we had. Yep. Exactly. If we were to kind of chop off the time period from 61 to 83 or so, and just look at this this last 35 years or so since then, this probability, and using the same model just over the shorter time period from 83 to present, this same model goes from a 32% chance of recession to a now 64% chance of recession. And sure enough, looking back, every time we were this high, we saw a recession in the U.S., at least within the next 12 months. Not to say that it's going on now, not to say that it's going to be a fourth quarter thing, but the data strongly suggest that we're likely to see in the next 12 months or so a substantial deceleration or outright recession in the United States.
A growing probability that this is going to happen.
Absolutely. And this Fed probability model is something that near and dear to my heart. It's something that I keep a pretty close eye on going forward. And certainly, if anyone has any questions on this kind of thing, or wanting an update or something of the sort, don't hesitate to contact us for that.
Great point.
Moving beyond this, I've shown lots of evidence, both boots on the ground and maybe more economic studies, economic models put out by the Fed and others showing the likelihood for a recession in the U.S. Someone thinks, okay, recession, big deal. Well, we're likely to see the Fed also, of course, has begun to cut interest rates. We saw the first interest rate cut here just a few weeks ago. The graph is a bit busy here, but it shows.
I know why you put this graph up, Gary, so you can keep your job, so no one knows what you're talking about. You got to keep paying your money and keep you employed.
That's right. They look at it and go, it's a spaghetti. It must be something important.
It's like what those tech guys do. They just speak all the mumbo jumbo. And
Sure. The important line here is the orange line, showing that's a pretty strong likelihood that we're going to see interest rates increase, that the Federal Reserve is going to increase its Fed funds rate in September. This is a model that is based upon options market of the likelihood. Essentially, it's not any mathematical model. This is based upon results from traders that are doing their thing every day, and just you can see, gosh, for the last 2 months or so, how it's gone from a 50-60% chance that they'd cut rates. It's now going to a 99.2% chance they're going to cut rates in September.
I'm sure if we charted the path of when the president started tweeting about tariff implementation, it jumped precipitously up top, right?
Sure. Kind of go back here a couple of days to when he said, who's the bigger enemy? Is it Jerome Powell or President Xi?
Bold.
Yeah, but we're all but certain to see another rate cut from the Federal Reserve. The market is only priced in a quarter point cut, but it's just about a done deal that it's going to happen at the September meeting.
What are the current rates right now off the top of your head? Do you know?
Yep, right here. It's on that quarter point range between 1.5 and 1.75.
Yeah, so I'm always confused because Peter Navarro says that the economy is slowing down because the interest rates are too high. So I look at 2% interest rate, and it's still free money to borrow debt for companies to expand and do all numbers. I mean, it's still it's personally, it's still almost free debt to go buy a car. I mean, they're doing like what, 6-year contracts at 0% for new cars coming out. I mean, this is not, it's not an inflationary period.
Not at all.
It's not a high interest rate period. So when they're talking all this stuff, it's just, you look at the numbers and it's obvious that I'm just a bit concerned that they actually know what's happening, and they're not trying to pull the fleece over certain people's eyes.
Oh, certainly. I agree with what you're saying, and it's beyond the scope of what I have shown here. But mortgage rates, phenomenally low. The 30-year bond is dipped. I saw, we showed a few moments ago how the 10-year Treasury bond is very low. It is low, and it's come lower over the last several weeks. So no, I would maybe disagree with Navarro on his view that interest rates are too high.
Yeah. Yes,
we're going to see him cut. It's going to be about a quarter point. It's, I think headed in the direction the administration would like to see them go. But the risk is that because we have been in this zero interest rate environment for so long, gosh, the bigger part of 10 years now, the Fed really doesn't have a whole lot of ammunition left. As they say, not a whole lot of dry powder should things go topsy-turvy.
Right.
So, one can make the case that, well, gee, the data here is showing that things are headed in a recessionary direction. Maybe we need to begin lowering interest rates. Well, that's what the Fed is doing. One can make the argument the Fed needs to be a little more aggressive. I'm a little more cautious there, I think the Fed knows best, and the Fed does not do it to score political points. They do it to fulfill their dual mandate of low unemployment and low inflation. But talking about kind of coming back to the slide I had shown a few moments ago, talking about household net worth. When you look at household net worth, and here's a graph going back, the 1950s. This is a household net worth as a percent of GDP. And when we measure it as a percent of GDP, that way you're saying, well, sure, compared to 60 years ago, who doesn't have more money? Well, yes, that's why they index it, or rather do it as a ratio, as a percent of GDP. The current ratio is 535%. When you look at this, every time over the last 60, 70 years, every time we've seen that ratio tend to get a little out of its long-term trend, you tend to see the wheels come off the bus. And an eventual recession, here we saw, of course, that coincided with the dot-com bust and the recession back in 2000, 2001. And then, of course, the housing bubble and Bear Stearns and, the issues there, Lehman Brothers and, the recession in Great Recession in 2007, 2008, and early part of 2009. With quantitative easing and the zero interest rate policy we've been under for the last several years, one could argue that it's another bubble, kind of like the two we had seen here, and suggests we're likely to see this retrenchment in U.S. Household net worth as a percentage of GDP. The point being, if households have less net worth, that you're likely to see that play out when it comes to consumers spending. And that takes me back to where we had begun earlier, looking at shoe store sales. Now, certainly, consumer spending, I think, is likely to continue growing on into 2019. But the issue is that consumer spending on footwear is a little more of a discretionary purchase. Do I buy 3 pairs today, or do I just maybe hold up and buy 2 pairs instead? Right. I talked earlier how we've seen this phenomenal growth in shoe store sales late 2018 and early 2019. 10% year-over-year growth for those couple months. But here the last couple months we've seen this pretty pronounced deceleration in shoe store sales. And I think if we are likely to see the chances for a recession begin to tick higher and higher with low unemployment, the industrial production number, teasing with going negative and going into contraction, and of course inverted yield spread, I think the likelihood for recession is certainly there, and it's continuing to strengthen, continuing to rise month over month. And I think in turn, that is likely to weigh on shoe store sales in the second half of 2019 and early into 2020. Point being, I think we're going to see a record year for shoe store sales in the U.S. this year, but not nearly as strong as the data had indicated that first half data is likely to indicate for full year 2019.
Right. So we're out of the gates with a big burst, but we're we're kind of stretching it towards the finish line a little bit and slowing down some. So
Absolutely.
When you're looking at this and people are saying, when do we estimate recession will hit? I mean, obviously you start talking about recession is 2 consecutive quarters of declining growth in GDP. So obviously we don't know we're in a recession until we're into it a little bit, down the line, a couple months into it at least. But I know economists are divided on this, and there's no real data to forecast when it actually hits. It's almost like a tornado, right? Like we know the bad weather's around, but we don't know when it's going to touch down and where. Otherwise, we'd let people know. But when you're looking at this, are we looking at kind of mid 2020 and our late 2020? Like when is the touchdown going to happen, you think?
Well, it's again a bit like the industrial production numbers that I had shown earlier, how it's just a hair above 0%, year-over-year growth. I think it was 0.5% in July, and some would argue that manufacturing is in a recession now. So it kind of depends upon your industry. If we're talking, the entire economy, the whole enchilada. Some models I've watched pretty carefully are showing fourth quarter is likely to see a substantial slowdown. But I've seen estimates from other economists out there saying it's going to be on into 2020. It might be second half of 2020. But point being, I think we're likely to see a marked deceleration in economic growth. Certainly we did in second quarter from first quarter. Right. I think we're likely to see that to continue on into the third and fourth quarter. Outright recession, that's perhaps for the pundits to discuss later. But I think we're likely to see things begin to decelerate, rather to continue to decelerate like we saw in the second half already. In the second quarter already, on into the second half of 2019 and early 2020.
I think the fear from a lot of CEOs we talk to and executives is that where we typically see cyclical environmental trends, recessions, growth, contractions, etc. It seems like we're in this environment of kind of disruption of that because we have so much with the trade war taking place. And it definitely is a trade war where you have President Trump ratcheting up pressure on China for all the right reasons on IP issues, for certain. I mean, that's certainly a great point. Our argument has always been tariffs aren't the exact tool that we need to use in that situation. There's many other tools at our disposal, but it seems to be putting fuel on the fire, and not just a gas can, like a whole oil tanker on the fire of how these cyclical movements are happening in our economy. And it seems that as we start to see prices rise at retail, which they will in the shoe environment, like you said, people will pull back spending because of higher prices, but also because of fear. I mean, fear drives. I mean, behavioral economics, even beyond the data, is I think very a salient way to look at how people make purchases and allocate scarce resources that they have. And sometimes it's an impulse buy, and sometimes it's a fear that can't make that purchase right now because you don't know what's going to happen in a couple of months with your job or with anything. So there's some great concern there. It is good that we did have a good start to the year. So that, when you look at year-over-year comps, I think from what you're saying, we'll be okay. We'll be a little bit, better than average, but certainly not what it could have been if we didn't have these trade disruptions that we're seeing. But in 2020, if I'm translating what you're saying, people need to start getting their houses in order, because you could see it could be a slight blip. It could be a big blip. We don't know what's going to come, but people need to be prepared in terms of their workforce issues, operation flows, things like that, right?
Absolutely. And so often with trying to time recessions, it comes to be a self-fulfilling prophecy.
That's right.
Everyone's talking about recession, therefore I better retrench my spending. Well, if you wouldn't do that in the first place, then that whole issue. So that's another issue as well, that you've seen the R word printed in many a paper online and print. And in fact, there's a neat Google graph that shows how many times the word recession is searched, and they overlay that with when recessions happen.
That's so true.
Yeah.
And I guess our point is today, it's not to make people afraid or fear, but we're just waving a red flag. That's basically like, this is a serious issue and a serious time. And, I always tell people, when did Noah build the ark? It was before the flood.
So true.
Start getting your houses and your ducks in a row, 2x2, if you will, and get on the ark and do that. But with that, Gary, thank you very much. I know for our members, members can go to FDRA.org and click on Intel Center, and you can find all of Gary's handiwork in there, from shoe store monthly data on total shoe store sales in the U.S., total consumer spending in the U.S., shoe prices month over month, shoe store employment. We've got material costs. We've got sourcing data, so you can overlay that and see what shoes are coming in category to see what your inventory is. There's a number of fun things that you can go into and keep up to date and measure yourself against, so that you just have more shoe situational awareness, I guess is the best way to say it. So, so with that, have no fear, but be prepared. Be a Boy Scout, I guess. With that, Gary, thank you very much. I hope you enjoy your cup of joe. Hope everybody enjoyed the show. Hope you gained a little bit more about that. Make sure you subscribe to Kicks Over Coffee, so you can be alerted every time we upload a new video. And until next time, we hope to see you at an FDRA event or listen to our podcast every Monday. Till then, see you next time. Bye-bye.
Bye-bye.